Some people know that old saying, as goes January, so goes the rest of the year. It's Tuesday, February the 3rd, and this is Markets with Megan. If you like this podcast, please subscribe, hit the alarm bell, share it with your friends, family, or colleagues, anybody who's interested in what's going on in the markets, what it may mean for your investments for the long run. But today we're going to take a focus on looking at the month of January and how market and the economy performed for investors. But first we want to start with this very old saying is, as goes January, so goes the rest of the year. And what that means is, if whatever the performance is for the month of January tends to dictate what investors can be prepared for the rest of the year. So let's look at that historical statement. When you go back to 1939, when the S&P 500 is actually negative in the month of January, it does end up being negative on average for the full calendar year, and it is negative about 60% of the time. But the good news is the S&P ended the month slightly positive. It was up a little bit less than 2% for the month. But if you go back to that same time period, when the S&P 500 is positive in the month of January, even if it's less than 2%, it is up about 90% of the time for that calendar year. And the actual average return is about 16%. Now, we did dig a little bit deeper, and when the return is that more muted, less than 2%, still positive 90% of the time, but it is less than the 16%, more in those low double digits, but still positive for the year. But let's break down from the economic standpoint for the month of January. We did see the labor market data that we got. Job creation did slow. It's actually on a rolling 12-month basis now that U.S. is creating about the least amount of jobs that we've seen since 2021. But because there's been some structural changes in the labor force, we are seeing the unemployment rate actually tick lower. Consumers do keep spending. We saw solid retail sales data. Inflation has been mixed. There is still some progress, but it's slowing significantly. And when you look at services, especially excluding energy, prices are still growing 3%. And then at the end of the month, we got the producer price index, which did surprise, where that super core number is growing about 3.5% on a year-over-year basis. From an equity standpoint, it was not just about the U.S. in the month of January. In fact, if you look at the MSCI All Country World Index and you exclude the U.S., it outperformed the S&P 500 by the most in 10 months. The international markets were primarily driven by Latin America, and that was due to the commodities rally that we saw for the month. When you look within the U.S., we did continue to see that rotation. Small and mid-cap stocks outperform large-cap stocks. The Russell 2000, which is the gauge of the small-cap stocks here in the U.S., it outperformed the Russell 1000, that large-cap index, by the most in 5 months. And when you look at both the S&P 500 and the NASDAQ, they actually had their slowest start to a year that we've seen since 2022. In fixed income, again, it was the markets took the fact that the Federal hawkish Fed comments that we got from the meeting, and interest rates did rise. The Bloomberg Aggregate Index was relatively stable for the month. It was about up 0.11%. But again, we did see yields rise towards the end of the month. It was more of a municipal story. We did see it's a big seasonal reinvestment month, so municipals did well. And while credit, both investment grade and high yield, did rally, we started to see spreads widen out a little bit at the end of the month, and that's because that's when we got the volatility from the equity perspective. On a commodity basis, it was all about energy this time around. The precious metals did rally significantly, but we saw a big pullback at the end of the month. From the energy perspective, it was geopolitical tensions with Iran, and then the cold freeze that we're getting here in the United States that caused natural gas prices to surge the most since we've seen since 2022. So a big rally in the energy prices. But let's talk about the precious metal space. Gold itself did have its best start to a year since 1980, but we did see a big pullback at the end of the month. We saw both gold and silver decline the most we've seen, have some some of the worst single-day declines in several decades. And that was because we had a stronger dollar when Trump nominated Kevin Warsh for the Federal Reserve chairman spot. And Kevin Warsh is considered by market participants as a little bit more hawkish than some of the other picks that Trump had. And also, they are less concerned about some political persuasion in that Federal Reserve coming up when the new chairman takes place in May. So that did help the dollar. It caused a big decline in the precious metals. So it just shows you how much leverage there is out there on the precious metals. And while most people consider them to be the ultimate safe haven, when you see the precious metals rally like we have, it is something to be concerned about and get used to these major swings that can be dictated by headline news. That's all we have today. If you want a history of our podcast, you can go to marketswithmegan.fm. Thank you.